There we go. Hey y'all, how you doing? How you doing? Wait a minute. I'm not coming in like that. I just got to get a little bit. Let me get a little bit. Come on. Come on in the room. Facebook was messing with me, y'all. It wouldn't let me in. But I'm here now. It must be some people out there that need this information today. The devil was trying to block it, but I'm here, y'all. Welcome to another episode of Unlocking Your Legacy. My name is Keith Robertson. I am the Fin Coach. Come on in the room. Thank you for tuning in once again. I see you, Linda. I see you, Javion. I see you, Ashley. Tanisha Izzy. Rock. I see you. Come on, y'all. Come on in the room. Come on in the room. I see you, Terry. I see you, Charles. All right. Thank you guys for tuning in and taking time out of your busy schedule to come see what it is that I'm talking about today, because you know I'm bringing some sauce. I just don't come here to just talk and just say something that doesn't have substance, something that you can't take away from this and add to your life immediately, that's going to bring back a harvest for you and your family. But thank you for tuning in. Welcome to another episode of Unlocking Your Legacy. My name is Keith Robertson. I am the Fin Coach. Thank you for tuning in. Like I said, I came in. Hey, listen, this wasn't CPT time. All right? I came in at 8 o'clock. For some reason, Facebook wouldn't let me in. It just clocked. So I had to go out and come back in. But nevertheless, I'm here now. Well, look, guys, let's just jump right in. Hey, listen, before I get going, I want to say this. Listen, there's another Facebook page. It's called Keith Robertson Personal Fin Coach. I want you guys to go over there and subscribe, like, and share, because this live is on my personal page. Is going to go over there. That way we can, keep business separate as we move forward in the future. And also, there's a YouTube channel, Keith Robertson Personal Fin Coach, as well. So if you could go there, look it up on YouTube, because I'm going to be going live in both situations here very soon. Listen, because it's about getting this information out, y'all. It's about making sure that people have the knowledge and wisdom and understanding, so they'll know what it is that they need to do as far as what's going on in this world that we live in, y'all, as far as an economical standpoint. And I want to say this before we get started, too, as we are in the political season. Make sure you vote. If you're not voting, don't complain. If you're a Republican or a Democrat, you pick your best horse, who's ever out there, and you vote. But make sure that that you are in tune with your local political parties as well. Your councilmen, your mayors. See what they're doing. See what the political agenda is in your city. Again, if you're not there, you don't have a voice. And if you don't have a voice, you can't complain if you weren't there. The senator race is very important. The senator and congressman, you got to keep in mind, they're the ones that actually write these bills. And they put them before the president. Yeah, the president has a stroke of the pen, but they're the ones that actually write the bills. And, a lot of these guys been in office for a long time. So you need to take a look and see, are they doing what they're supposed to do for you? But anyway, let's get on it. Hey, listen, I want to touch this real quick. I had a comment talking about the $1 Million Baby policy last week. Now, when I talked about the loan for that, I was explaining that, okay, it's not truly a loan, that your cash value in that IUL, that Index Universal Life Contract, which is an insurance policy, your cash value for that is used as collateral for the loan that the insurance company will give you, because they don't take that capital out of your cash value, but they take it out of the big part, which is called the insurance general fund. Now, let me make it real plain for you. Let's say you're going to buy a car, right? You want to go buy a car, but you're going to use money from the cash value in your insurance policy. What you're going to do, you're going to reach out to the insurance company, say, hey, I want to get a loan. I want to get $25,000 out of my cash value. They're going to take that $25,000 out of cash value. They're going to take $25,000 out of their general fund to give you, but your cash value in your insurance policy is used as collateral. Now, what is the benefit of that? Pure and simple. Listen, first of all, you're gonna get your car, As soon as you pay for the car, you're going to get the title. You're going to get the title. It's not going to be reported to the bureau. Now, what is the other benefit? Okay, yeah, you borrowed the money from your cash value and your insurance policy. It came out of the general fund, but yet you're still going to pay it back. Because if you don't pay it back at your unfortunate or the time of your demise, that money that you borrowed from your cash value will come from the face value or the payout of the face value of the death benefit of that policy. So we always want to pay it back. We're not, again, eating our seed. We eat from the tree. We don't eat the seed from the apple. We eat from the tree. And so we always pay it back. You pay it back, and what's the benefit? Well, you're paying the loan back, but you're paying the interest to yourself, and that is the true benefit, y'all. You get that money tax-free. So, yeah, and you set your own terms, right? 3, 5, 7 years, whatever the case may be. Just like a car loan, if you're buying a car, you're not going to put a car loan out 10 years to pay it back. You're going to pay yourself back just like you were paying a financial institution. But let's move forward, guys. I had to get that out. Now, look. Okay, what's happening in the economy? Okay, yep. Okay, the Fed chair, he did lower the rate, and you know, so many people were looking for that to have an instant effect on the housing market. The rates are going to come down. If you look at the news, though, they are talking about, oh wow, look at this. We have a landslide. That it's a run on housing. You know, people are running out buying houses. Well, listen, guys. In the past couple of years, they haven't been buying houses. Right? They haven't been refinancing. They're talking about a refinance boom. People haven't been refinancing, right? Because the rates were so high. So now today, yesterday, if you had one person refinance their home, and then today you had 2 people, that's a 200% increase, right? So don't get caught up in the news and the market. Really use this. This is why we're here talking about these things. Now look, guys, when we look at what's going on in the stock market right now, it's really 8 companies that is actually shoring up our S&P 500. Those 8 companies are NVIDIA. We have NVIDIA. Actually, I haven't listed right here because I want to make sure I didn't miss them. Apple, Microsoft, Amazon, NVIDIA, Alphabet, which is Google, Tesla, and of course Berkshire Hathaway, and the Meta platform, formerly Facebook. So those are the 8 stocks that's really showing up our economy. So what am I saying? I'm saying 35% of every dollar that goes into the S&P 500, 35 cents of that dollar goes to these 8 stocks. That's right. So, you know, we kind of keep that in mind as we're looking at higher highs going towards 6,000, and there's going to be another correction. And keep in mind, again, this is just for informational purposes only. We're not focused on investments right here on this show. We're focused on safe vehicles where you can realize the gains and won't have to be worried about losses. We're only talking about opportunities where you can realize gains and not have to worry about losses. That's the key thing when we're talking about passing on a legacy, right? We want to protect that legacy. But investments are a big piece because you have to have a healthy balance, right? It was 60-40, 60 and something safe and 40% in the market, but that actual tier that they used to use has changed. But in any case, so when you look at what you're doing right now, keep in mind it's going to be another correction. I told you guys about a correction a little while back when the actual stock market, it does a correction, right? Because it can't always go up, and it's going to test its all-time highs. And then if it has a correction and it pulls back, best believe going into the end of the year, it's going to shoot back up, and it's going to give individuals that are watching it opportunities to make money in this stock market. But so listen, I want to move forward and talk about why we're here. You know, I was told that people aren't focused on tomorrow, especially you young folk. Not focused on tomorrow. As long as you keep waking up, there's going to be a tomorrow. And what I say, what do you do when your tomorrow is today and you didn't plan for it yesterday? When we talk about these insurances, I want you guys to understand this. We are talking about We're talking about financial instruments and how to use them in an effective manner in which you're able to realize increased cash flow and be able to pass along that wealth to your next generation. This is what the play is about. It's not just about the death benefit. The death benefit is a real thing. Now, when I went across that $1 million baby policy last week, that was a real client. That was a real situation. They were putting $200 in, and they were gonna, when the child reached 24, they were gonna pull 40 out for the child, and then when the child reached 65, he was gonna have $117,000 a year for the next 25 years in income. That's a real scenario, and that's all behind $200 a month. Now, everybody can't afford $200. I understand that. But get in where you fit in. Where are you right now today? This is why I'm here. I want to help you, right? I want to help you position yourself for your future. The benefit of coming to an independent broker like myself, I represent 40 of the largest insurance companies in the life space, and pretty much all of them in the health space, as well as the annuities. But the benefit of that is that when you come down and we do a financial analysis, someone like myself, we're able to give you the best option for you at that particular time, because we don't have to give you the only thing that we have, right? You go in an ice cream store and they want to have vanilla ice cream, what are you going to get? Vanilla ice cream. But that's not like that when you go to a broker that has the contracts with the larger firms or the best firms. Some of these firms have been around for 150 years. 150 years. Matter of fact, the insurance contract in which I went over last week, that firm had been around for over 100 years. And we talk about a mutual company that's paying dividends. We always want to look at an insurance company that's been around for 100 and 150 years and have consistently paid that dividend out, where we can go back and say, hey, this is not a bet. This is a safe vehicle in which we need to participate in. Now, when we look at where we are today, it doesn't make a difference. I want to be clear on this. It doesn't make a difference if you're black, white, brown, yellow, green. I don't care what it is. This is for everyone. We have to put these things in place. See, a lot of times they use race to separate us because they know if we ever came together as a complete people, right? We wouldn't stand for what's going on in a lot of situations. They keep us divided from an economical standpoint, where they tried to eliminate the middle class, right? But that's not happening because we're here now. And we're learning how to utilize the tools of the wealthy. Now, in my post, one of the things that I talked about was the 10 most asked questions, or the 10 most questions asked an insurance agent, and the 10 things that you need to know when you're contemplating getting insurance. Number 1. All right. What is the difference between term insurance and whole life, cash value insurance? Okay. Plainly put, term insurance is this, right? You have a term. You have a beginning point, you have an ending point. Now, typically 10, 15, 20 years, 30 years, and there's a carrier out here that actually will engage in 35 years. But you have that term, so you go in and you buy coverage for that term. That's a great benefit when you're a younger person and you're starting your life, because you can get a couple $100,000 for under $100. You can really position your house to be protected. You go in and you're buying a home, and you hear this term mortgage protection. Well, that is a term policy that's used. But sometimes, they bedazzle the mortgage protection, and you should come to someone like myself and just get the best possible term that is for you and your situation, versus going after the quote-unquote mortgage insurance. Okay? But the bottom line, term is from point A to point B. You have a term. 10 years. From 10 years it starts, and 10 years later it ends. The benefit of that, it comes at a lower cost, but the con to it, when it's done, it's done. Now, you can get, certain riders that will help you with that as well. With your term, you can get what's called a return of premium rider, right? So at the end of that term, you get your money back, minus the fees in which it costs yearly for that insurance. But you get most of your money back. So that's great. So you were protected for the period of time. You got that money back. Hey, you got that money. You can probably put it somewhere to work. So think about that. And then you also have income protection that go along with those policies as well. Income protection. You can get other riders, right, which we're going to talk about in a minute. But then we have whole life. The difference in whole life is that it will cost you more than the term insurance, but it builds that cash value. Okay? It builds that cash value. And this is why you need to sit down with a person and make sure that if you're getting a whole life policy, you get the one that's right for you. Because if you get the one that's right for you, it's the great place to house your money versus saving your money in the bank. Saving it in the whole life policy, because what happens with that whole life policy, the cash value, it increases. And again, we're going back, when you borrow from it, it comes out of the general fund, and you don't lose the power of compounding interest on your cash value. So you're able to, again, realize some of the gains that you get by having it in that cash value. But bottom line, the difference in term and whole life is, the whole life, you keep it for the duration you have for your whole life. That's why they call it whole life, right? And it has that cash value where you're able to take advantage of the cash value. And when those whole life policies are structured and funded properly, they are a great financial vehicle. Being your own bank, in some cases having a structure so they will actually help you through retirement. Question number 2. How much life insurance do I need? Okay. Rule of thumb about how much life insurance do you need. Typically, they say 7 to 10 times your annual salary. Because if you think about it, right, when you're getting that insurance, you're talking about 7 to 10 times, you're talking about you're going to have the same amount of income that you have today or this year for 7 to 10 years. Now, does that make sense for you? Again, it's about a complete financial plan, though. You know, so it's no one size fits all. You know, generally, this is what they say, 7 to 10 years. But, of course, you need to sit down with a professional and see what's right for you. But the bottom line is that insurance is to protect your future. Insurance is something that, you know, we hope we don't need it, but, Lord, when a situation occurs and we have it, we are so grateful. But when we don't have it, it creates a financial travesty in the household and the family. You know, many families have come disengaged because of not having, you know, proper coverage or having insurance. And someone meets their demise unexpectedly, and there wasn't insurance in place, because we've been focused, or many people focus on the death benefit. But it's much more to this. These are vehicles that have been used by the wealthy for decades to pass along their wealth. What we think about only, or the majority of the population only think about their death benefit. Oh, this is when I die. But it's much more to it. When should I buy life insurance? As I did in the illustration last week, the wealthy, what they do is, as soon as a child is born, 15 days later, they put a policy on that child. And it's actually overfunded, typically a lot of times. So when that child gets older, they have money in which to start their life. But wherever you are right now, if you don't have insurance and you're listening to the sound of my voice, the time for you to get insurance is now. Period. To protect you and your family. But from a standpoint of what the wealthy do, as I stated, from the point in time the child is born. Now, if you're in your early teens, you know, maybe you're looking at the term insurance. But if you're 40, you're in your 40s, especially if you're in your 50s, you need some whole life. You need to build up that cash value, you know? Okay, question number 4. Can I get insurance if I have a health problem? So this is one of the things that I put in the chat. You know, one of my clients, you know, they have severe diabetes, And because I represent 40 of the largest insurance companies in the U.S., I was able to structure them a plan in which they were able to get protection. So yes, if you have an ailment, you're able to get coverage. Now there are some automatic disqualifiers out there, but yet now today there are more companies that are willing to give you insurance so you can protect your families. Because you got to keep in mind, insurance companies are they've been around for as long as Roman times. Your bank has money in insurance policies because it's a safe vehicle that grows. Look it up. Now, when we look at this one right here, right, the health problem. Again, you need to sit down with a professional and see what's best for you. Just don't, you need options. So don't just jump at the first thing that you see. You want to make sure that you have the best option. Know that the company in which you're looking to go with, they've been around for a number of years. And like I stated, insurance companies are stable. Because look at this, if insurance company was to fold, right? Like banks fold. But if the insurance company was to fold, another insurance company is going to grab them up. I'm going to tell you why. The reason why an insurance company is going to grab them up is because they have all those customers of that insurance company in which they can get as customers, and they don't have to pay any commissions out to agents. It's a win-win for them. They're going to get those customers at a discount, and they don't have to pay the agents any type of commission for that business, so that just increases their book of business. Okay, what is an insurance rider? Okay, that is what I was talking about a moment ago. So when we're talking about income protection, but a lot of times the riders that we're talking about is what we would call living benefits. Living benefits is when you may have something like a critical illness, terminal illness, and what happens at that point in time is that chronic illness. What happens at that time, your benefits, or you're able to accelerate the benefits on that policy. Let's say policies with critical illness or terminal illness, right? And your doctor give you a diagnosis. The insurance company will give you some of that face value. In some cases, 100% of that face value, but of that money, so you're able to live comfortably, and as you make that transition through life, and then we have chronic illness, right, where you have dementia, Parkinson's disease, multiple sclerosis, things of that nature. These are riders in which are put on to the insurance policy, so you're protected against those things. Of course, you possibly have long-term care and things of that nature, but still, this is something that jumps into place that will help you as you navigate through that part of life. How you doing, Ashley? Okay, number 6. How often should I review my life insurance policy? Yearly. With each of my clients, what we do is we call this an annual review, where we sit down and we do a financial, again, another expert financial analysis to see exactly where you are. Because like I said before, when you have insurance, you need to, it's like a car, right? You have to change the oil, you have to check the air and the tires, you have to fine tune it, you have to tune it up after they get a certain amount of miles. You have to do your maintenance check. And your insurance is the same way, because listen, change is constant. So to make sure that the plan in which you were put in is one that still operates as the way you wanted it to operate when you first put it into place. So yearly review at a minimum. Sometimes it may be quarterly. It depends on how you have your plan structured. Okay. Can I change my beneficiary? Okay, the beneficiary is the person that you have, at the point of your demise, you choose the person which is going to be paid the death benefit. And the owner of the policy is able to change that beneficiary. They can change it as many times as they want to, and they can divide it up into as many people as they want to. And so the answer is yes. Number 8, what happens if I miss my premium? Well, what happens is that you have what's called a grace period. You have a grace period. So if you miss your premium payment, you have a grace period in which you're able to make that payment. And then if a person was to pass during their grace period, what they would have to do is they would actually still receive their death benefit minus the deficiency in those payments in which weren't made. Can I cash in my insurance policy? As we talk about a cash value, sure you could cash it in, but the problem with cashing in, you may realize taxation at that time, because again, you can borrow from the cash value. You don't cash. It defeats the purpose of having that policy when you cash it in. Borrow from it, and then those funds are given to you from the general fund. But again, I say if that loan is not paid back, it's taken from the death benefit. So the death benefit will pay that loan off, and then your beneficiary will get that remaining dollar amount. So yeah, you could cash it in, but why would you? Oh, okay. Here's one. Here's the last. What is the difference between a term insurance policy and a universal life policy? Okay. So again, a term policy is from point A to point B. It has a beginning time period and it has an ending time period, 10, 15, 20, 30 years, and that's it. You're covered for that time. A universal insurance policy is a cash value policy that's typically attached to some type of index where it has dividends that come in that policy, and it's attached to some type of index where it's actually attached to the market to a certain degree, but it doesn't play the market game. It's attached on, as I explained last week, a point-to-point system. So at the point in time when you initiate the policy, 12 months later, there's a review done, and if that during that time, the way it's structured, if you realize gains from the market, you get those gains. But if it was lost in the market because it has a floor, you won't be penalized with that floor. So again, we always talk about safe policies, y'all. But anyway, guys, hey, look, that was the 10 questions, the 10 most asked questions. Hopefully that gave you some insight. Listen, again, please like, share, and subscribe, not only here to this page, but also to Keith Robertson Fin Coach, and also Facebook, Keith Robertson Fin Book. Keith Robertson Fin Coach on Facebook, but also Keith Robertson Fin Coach on YouTube. And as we come into the open enrollment, we're going to be talking about Medicaid, Medicare, and ACA. That's the next hot topic, y'all. And know that you need to reach out to a professional and actually find out, what are the changes to ensure that you're not overcharged in some cases. Where you don't have plans, you don't really understand your plan until you try to use it, then you find out the deficiencies in that plan because you didn't sit down and talk with the insurance expert. But in any case, y'all, thank you for tuning in once again. My name is Keith Robertson. I am your personal fin coach. Listen, come see me next week, next Thursday at 8 o'clock, and I'm going to bring some more information for you. Next week, we're going to change it up a little bit. Next week, we're going to talk about some loans this time, y'all. We're going to share some information because I was asked about the different types of loans that are available to people with businesses, and they asked me if I could actually speak on that, and I'm going to. But in any case, again, my name is Keith Robertson. I thank you for tuning in. Hope to see you next week. Peace and blessings.